Hello, ACC community. Today I'm going to explain accounting standard IAS 37 provisions, contingent liabilities, and contingent ICs. Before starting this standard, I would like to explain the definition of provision. Provision is a liability of uncertain timings or in amount. For instance, warranties. Generally, we don't know about the warranties claim. Like generally, when customer claim for service warranties or product warranties, so we don't have any idea so that when is our customer is going to claim and when we by how much amount he is going to claim warranties. So that's why we call these warranties as provisions. Taxation, dismantling provisions, onerous provisions, restructuring provisions. So all these type of provisions are not confirmed in terms of timings or an amount. On the other hand, we have different liabilities like trade payables, overdrafts, loan notes, accruals. Uh, all these liabilities are confirmed liabilities. We know about these liabilities that when our liabilities are going to settle. So that's why they are not uncertain or like in terms of amount or timings. We already have an idea that when when we are going to settle these obligations. So that's why they are not falls under the definition of provision. So that's why we call these liabilities as confirmed liabilities. They are not estimated liabilities. There are no judgment involved in these liabilities. The question here is that when we measure provisions in our books, by books I mean financial statements. So IAS 37 defined the recognition criteria, and this criteria include three conditions. The first one, present obligation. The second, probable outflow. And the last, reliable estimate. Remember, we are not allowed to record provisions in our books if any one of these conditions are not met. Provision is an estimate, and that's why this standard is quite controversial standard because we have a lot of judgment involved in this standard. So IAS 37 is strictly prohibit entities to record provision in their books if they are unable to meet any one of these conditions. So we must assure that these three conditions are fulfilled by the entity. So let's talk about the recognition criteria one by one in detail. Present obligation. As we know, provision is a liability. So as per definition of liability, liability is a present obligation arises as a result of past events, the settlement of which is expected to result in an outflow of the resources. So liability is of two types. It may be legal or constructive, depending upon the case. As far as legal obligation is concerned, It is an obligation which is due to the application by rule of law. For example, taxation. Taxation is a legal obligation on the entity. Lawsuits, environmental fines, dismantling provisions. So all of these types of liabilities are legal obligations on the entity, and these are mandatory by rule of law. As far as constructive obligation is concerned, constructive obligation is a liability which is due to the own published policies or past practices of the entity itself, which will create the valid expectations in the eyes of users. For example, I have a business of laptop, and I'm doing this business for last 10 years, and it is my past practices that I will uh, provide high quality headphone along with laptop for last 10 years. So providing a high quality headphone along with laptop, this will create valid expectations to all of my customers. So that is something which is constructive obligation, which which is created, or you can say which is obligatory on the entity by itself due to their past practices or published policies. So the second criteria, which is probable outflow. So let's understand the treatment one by one, along with some terminologies, along with the probabilities assigned with that. So if the chances is remote, like it means that there are 10% or less than 10% chances, which means not likely to happen. So we will do nothing in this case. If the likelihood is possible, means there are 10% to 50% chances, less likely to happen. And in this case, we are required to give the disclosure to the users. It means that, you know, the chances are less likely to happen, but still we disclose this matter in the notes to the users of financial statements. In case of a probable, like if the likelihood is probable, it means there are more than 50% chances, then uh, it is most likely to happen. So in this case, we record provision in our books. For virtually certain, uh, in terms of percentage, more than 95%. So we will record this as a liability because it's certain. The third criteria, reliable estimate. By reliable estimate means that how we measure the amount of provision. So whether it is a single-ended outcome or you can say multiple outcomes. The estimation of a correct figure is depend on the case, whether it is single or multiple outcomes. So if we will talk about single ended outcome, like for example, if this is a one single case, for example, court case, so management should reflect the best estimate. it should be the most likely outcome as per prudence concept. And in case of multiple outcomes, like for example warranties, uh, in which we have surety that we have not just a single outcome, we have a couple of outcomes, like probably it's gonna one, two, three, or more than two or three. So in this case we will use expected values, and this is done through outcome into probabilities. So whatever we have outcomes, we will multiply this with probabilities, and the sum of these is expected value. So this is the correct way to measure the amount of provisions. Accounting entry of provision is simple. You will debit the expense account and credit the liabilities account, provision account. So provision is a liability, and when liability created, you will credit the liability account. So we have two terms: increase in provision and decrease in provision. So when we calculate at the reporting date, when we calculate the opening balance and closing balance, when the difference comes out from these two balance, it may be a result of increase or decrease in provision. So if there is increase in provision, it will be treated as increase in expense, because if increase in provision, it means liability increases, and when the liability increases, you will credit this account. Similarly, if decrease in provision, it means then your liability decreases. So when liability decreases, you will debit the liabilities account. So provision in this case debit, and your income will be decreases. If you like this video helpful, so please like, subscribe, and comment below if you need any explanation regarding this standard more in details, or if you want me to explain accounting treatment more in detail. So please comment below, like, subscribe this channel, and share this video more and more. Thank you.